Welcome back to the deep dive. If I had to pick a word of the day for today's session, it would have to be breakout.
That is the perfect word for it, yeah.
Because if you've been watching the fintech space since, say, late 2021, you know the story. I mean, it has been a brutal fintech winter.
Oh, absolutely.
Interest rates went through the roof, funding just vanished, and the big question looming over companies like Upstart was, well, does this business model actually work when money isn't free?
Right. Can an AI lending model survive a real economic stress test? The skeptics were very, very loud.
Well, today is Tuesday, February 10th, 2026. Upstart just dropped their Q4 2025 earnings, and I think it's safe to say they didn't just survive the winter, they might be inventing a whole new season.
The numbers are pretty shocking in a few places.
Before we dive in, this analysis is brought to you by STOCKANALYTIcs.AI. Get institutional-grade research on over 600 stocks for just $10 a month. Plus, request any ticker and download your own video analysis. Start your 7-day free trial at STOCKANALYTICS.AI. Now let's get into it. So let's set the scene here. The stock is up, what, about 11% in after-hours trading as we speak?
A lot of green on the screen, yeah.
But the funny thing is, the initial headlines when the press release hit were a complete mess. Did you see that?
Oh, it was chaos. It was all over the place for about 15 minutes.
I was refreshing my feed right when the report dropped, and I just saw all these automated alerts saying, Upstart missed earnings.
Red flags everywhere.
And then 5 minutes later, the stock just rips 11% to the upside. So
Yeah.
help us separate the signal from the noise here. What actually happened?
This is a classic case of, algos versus humans.
Yeah.
It's what happens when you let bots read complex financial statements without any context.
All right.
But when you actually open the press release, which, we've done, and you look at the real profitability, the story changes completely.
Okay, so let's walk through this systematically because there is a lot to unpack. I'm pulling up our first visual here. Slide 1, the at-a-glance scorecard. Let's start with the headline number. Revenue. They brought in $296 million for the fourth quarter. That's a 35% jump year over year.
Which is a very strong showing. For context, Wall Street consensus, what the analysts were guessing, was around $288.5 million.
So a comfortable beat.
A comfortable beat on the top line. But honestly, the revenue isn't the main event here. The main event is the bottom line.
The profitability.
Specifically, GAAP profitability. For the first time in a long, long time, Upstart is in the black on a GAAP basis.
And for the listener who isn't an accountant, when we say GAAP, we mean generally accepted accounting principles.
Right.
This is like real unadjusted profit, no fancy math.
Exactly. They posted net income of $18.6 million.
Wow.
Compare that to a year ago when they lost nearly $3 million. That is a massive psychological threshold for investors. It proves the business isn't just growing, it's sustainable.
It puts that whole cash burn argument to bed.
It does.
Okay, so if they made $18.6 million in real profit, why did those bots I saw scream miss?
It all comes down to earnings per share, or EPS. The consensus estimate on Wall Street was 46 cents. But, and this is the key, that was an adjusted estimate.
Meaning analysts were expecting a number that ignores things like stock-based compensation. They strip out the non-cash stuff.
Correct. They want to see the core operating power. But the automated news bots, they just grabbed the GAAP EPS from the report, which was 17 cents.
So they compared an unadjusted apple to an adjusted orange and flagged it as a miss.
Total disaster for anyone trading on headlines.
Yeah, but the human traders figured it out pretty quick.
Instantly. You all do the math. If you add back the stock-based comp of about $33 million, Upstart's adjusted EPS was actually around 51 cents.
So they were expected to hit 46, and they actually hit 51.
They crushed it. It was a clear beat.
And that explains the after-hours surge to around $43. The market just repressed the risk on the spot.
It did. It's the realization that this isn't some distressed asset anymore. It's a profitable growth company again. The risk profile has completely shifted overnight.
But this is where I want to dig in because the how is more interesting than the how much. I was looking at the transaction volume, and the math just wasn't adding up for me at first. Let's look at the next slide. Slide 2. The engine of profitability. So here's the paradox I found. Transaction volume, the number of loans, exploded by 86% year over year.
It's a staggering number.
455,000 loans in a single quarter. nearly 500,000,
Yeah.
but revenue is only up 35%.
Right.
So simple math tells me they're selling way more widgets but getting less money for each one. What's going on?
You spotted the mix shift. The average loan size dropped pretty significantly, actually,
How much?
from about $8,500 a year ago down to around $7,000 this quarter.
So much smaller loans.
Much smaller loans. But here's the thing. Usually in lending, small loans are a nightmare for profitability.
Because the paperwork costs the same whether the loan is for 5 grand or 50 grand, right?
Exactly. The man hours are the same. So if your loan size drops, your margins usually get crushed.
Yeah.
But this is where Upstart's, magic trick comes in.
Okay.
Despite volume nearly doubling, their customer operations expenses, the cost to actually process these loans, went down by 22%.
Wait, say that again? They did 86% more work with 22% less cost.
That's it. It's the definition of operating leverage. And it's all driven by one metric they updated us on, 91%.
The automation rate.
Yes, 91% of their loans are now fully automated. No human intervention, no phone calls, no manual document review, just click, verify, fund.
So they've decoupled their costs from their growth?
Completely. The machine is doing the work. They can double volume again, and their costs will barely budge.
But that begs the question, if the machine is approving people that fast, is it approving the right people? Or are they just opening the floodgates to juice the numbers?
That's the fear, right? Sacrificing quality for quantity.
But you have to look at the conversion rate. It's up to 19.4%,
And a year ago, it was what?
18%. And during the worst of the credit crunch, it was down near 9 or 10%.
So the funnel is almost twice as efficient as it was during the lows.
It implies the AI is getting smarter at finding those hidden prime borrowers. They're approving more people faster and, crucially, doing it profitably. The model is validating itself.
Okay, so operations are efficient. But I noticed they aren't saving money everywhere. There was one expense line that did explode. Slide 3. The engine room business segment performance. Sales and marketing expenses were up 63%. That's a massive jump.
It is.
So they're saving money on ops but blowing it on ads. What's the trade-off? Think of it as deliberately buying growth. Because they spent so much acquiring customers, their contribution margin, the profit on each loan, compressed from 61% down to 53%.
That's a pretty steep drop in margin.
It is, but 53% is still very healthy unit economics. Management is making a calculation here. They're saying the credit markets are thawing, competitors are wounded, now is the time to grab land.
A land grab. Maximize absolute profit dollars, not the margin percentage.
Precisely. And they aren't just grabbing land in personal loans anymore. This report gave us some really solid data on their diversification. Did you see the numbers on auto and home?
Yeah, originations grew 5x in 2025. That feels huge because for so long, Upstart was just a personal loan company.
That diversification is vital for stability. Personal loans are unsecured, but people need their cars. They need their houses. By scaling auto and home, they're diversifying their risk profile.
And it looks like the funding partners are finally buying into that story too. The funding freeze was the big issue in 2023.
And that freeze has thawed significantly. They announced they secured funding partners for 70% of those auto and home loans
70%.
from 11 different partners.
Yeah.
Institutional capital is back.
Which brings me to the next slide, which I like to call the sleep well at night slide. The balance sheet. Slide 4, financial strength and shareholder rewards.
You hit the nail on the head. The biggest risk reduction in this entire report is right here. They reduced the loans held on their own books by 20% just this quarter.
Down to under $1 billion held. And remind the listener, why is that so important for them?
Because Upstart is supposed to be a marketplace, not a bank. They're a tech company.
Right.
When they hold loans, they take on credit risk. If someone defaults, Upstart loses money. Getting those loans off the books proves the marketplace is functioning again.
Plus their cash position. I mean, they're sitting on a mountain of liquidity.
Over $1.05 billion in cash and restricted cash. That is a fortress balance sheet.
So $1 billion in cash, they're profitable, and the balance sheet is cleaner than it's been in years. The turnaround seems legitimate.
It checks every box. It's really hard to find a hole in the financial argument right now.
But the thing that's going to dominate the chatter tomorrow isn't just the balance sheet, it's the people sheet. There's a massive shakeup at the top. Slide 5, the road ahead management's outlook and key takeaways. This was the bombshell at the end of the call. Dave Girouard, the co-founder, the face of the company, the Google guy, He's stepping down as CEO.
And Paul Goon is taking over on May 1st. The timing here is just fascinating.
For those who don't know, who is Paul Goon? He's not your typical CEO type.
Not at all. Paul Goon is the other co-founder. He's the technical architect. He's a Thiel Fellow, part of that elite group of geniuses paid to skip college and build things.
He wrote the code for the original model.
He literally did. So you're swapping the operator for the architect.
What's the signal there?
The signal is the crisis is over. Dave was the wartime CEO. He steered the ship through the storm. Putting Paul Gu in charge says the innovation phase is back.
It feels like a statement. They're doubling down on being a deep tech, generative AI company, not just another lender.
100%.
Yeah.
You don't put your chief data scientist in charge if your goal is just to cut costs. You put him in charge if your goal is to fundamentally change the product. It's a very aggressive, tech-forward move.
And looking at their guidance, they clearly expect that tech to deliver. I did a double take on the 2026 forecast.
It was a shocker. I think everyone had to reread it.
Wall Street was expecting, what, $1.27 billion in revenue for 2026?
Yeah, we're on there.
Upstart came out and guided for $1.4 billion. That's a massive gap.
It implies 40% growth next year. You have to understand, you do not guide for 40% growth if you're worried about the economy. That is extreme confidence.
And they didn't stop there. They gave a long-term framework through 2028.
Yeah, targeting 35% annual revenue growth, a CAGR, through 2028.
That's hyper-growth territory.
If they hit that, the company basically doubles in size in under 3 years. And they're targeting a terminal adjusted EBITDA margin of 25%. They're saying, we're going to get huge and we're going to be highly profitable doing it.
It's an incredibly aggressive outlook. They're basically telling the market, catch us if you can.
Yeah.
So let's pull this all together. We have a breakout quarter. Revenue is up. They flipped to profitability. And the whole AI lending thesis seems to have survived the ultimate stress test.
They took a beating, but they didn't break. And now they're leaner, more automated, and frankly, battle-hardened.
I want to leave us with a bit of a provocative thought, though. With Paul Gu taking the reins, where does this actually go?
That is the big question.
Because if the AI is truly this good, if it can automate 91% of loans and find borrowers' FICO misses, does Upstart just keep using it for themselves?
Right. Do they keep trying to be a better bank? Or do we see a pivot? Do they start licensing this brain to the entire financial system?
The Intel Inside for credit.
Exactly. Or the AWS of lending. If they do that, the addressable market isn't just billions. It's the entire global credit system. It becomes the everything store for credit.
It's a wild possibility to consider.
But with this leadership change and this level of performance, it's not off the table.
It's certainly going to be an interesting year to watch. The pivot from survival to offense is officially underway. And now, before you go and put your life savings into this based on our excitement, a mandatory disclaimer. This is not financial advice. We are just two voices analyzing the data. You need to do your own research. Also, please note that the content of this deep dive was generated by AI based on the source material provided. Want institutional-grade stock research without the institutional price tag. Check out STOCKANALYTICS.AI. For just $10 a month, you get full access to our deep dive video library covering over 600 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify. Can't find the stock you're looking for? Request analysis on ANY ticker and download your own video within 24 hours. Upgrade to Pro for $20 a month and unlock our SEC risk scanner, which detects red flags in company filings before they hit the headlines, plus our portfolio diversification analyzer to optimize your holdings. Start your 7-day free trial today at STOCKANALYTICS.AI. Make smarter investment decisions with research you can trust.